Hi everyone, welcome to Commerce Earth YouTube channel. In today's video, we are going to see about understanding financial statements, balance sheet, income statement, cash flow. If you're new here, please don't forget to subscribe to the channel and click on the bell icon to never miss a notification. Every business, whether small or large, generates financial information about how it operates. This information helps business owners, investors, managers, and analysts understand how well a company is performing. The most important way to examine a company's financial health is by studying its financial statements. Financial statements are structured reports that summarize the financial activities of a company over a specific period of time. They provide insights into how much money a company earns, how it spends that money, and what resources it owns or owes. There are three primary financial statements used to analyze a company: balance sheet, income statement, cash flow statement. Each of these statements serves a different purpose, but together they give a complete picture of a company's financial condition. The balance sheet. The balance sheet shows the financial position of a company at a specific moment in time. It answers an important question: what does the company own, and what does it owe? The balance sheet is built around a simple accounting equation: assets equals liabilities plus equity. This equation always remains balanced, which is why the statement is called a balance sheet. Assets. Assets are the resources owned by the company that have economic value. These resources help the company operate and generate income. Common examples of assets include cash in bank accounts, inventory of goods ready for sale, machinery and equipment, buildings or office property, investments, accounts receivable, money customers owe the company. Assets are usually divided into two categories. Current assets are resources expected to be converted into cash within 1 year, such as cash, inventory, and short-term receivables. Non-current assets are long-term resources that the company expects to use for many years. Examples include buildings, machinery, and investments held for the long term. Liabilities. Liabilities represent the obligations that the company must repay in the future. These are the debts or financial responsibilities the business owes to other parties. Examples of liabilities include bank loans, credit lines, accounts payable, money owed to suppliers, taxes payable, employee salaries owed, long-term debt. Liabilities are also divided into two categories. Current liabilities are short-term obligations that must be paid within a 1-year period. Examples include supplier payments and short-term loans. Long-term liabilities are debts that extend beyond 1 year, such as long-term bank loans. Equity represents the ownership value in the company after liabilities are deducted from assets. It shows the portion of the company that belongs to its owners or shareholders. Equity can include initial investment by owners, retained earnings from past profits, additional shareholder investments. If a company sells all its assets and pays off all its liabilities, the remaining amount belongs to the owners. That remaining value is equity. The balance sheet therefore provides a snapshot of a company's financial position at a particular date. The income statement. While the balance sheet shows a company's position at a specific moment, the income statement shows financial performance over a period of time. It answers the question of whether the company is earning a profit or incurring a loss. The income statement records revenue earned by the business and expenses incurred during operations. The basic formula of an income statement is revenue, expenses equals profit or loss. Revenue. Revenue is the total amount of money a company earns from its business activities, such as selling products or offering services. It represents the total income generated before expenses are deducted. Examples of revenue include sales of goods, service fees, subscription income, consulting income. Revenue is sometimes called the top line because it appears at the top of the income statement. Expenses. Expenses represent the costs involved in running the business. These are necessary expenditures required to generate revenue. Common business expenses include employee salaries, rent for office space, cost of raw materials, utility bills, marketing and advertising, transportation costs. Expenses are subtracted from revenue to determine profitability. Profit. After deducting all expenses from revenue, the result is profit. Profit indicates that the company earned more than it spent during the period. If the total expenses are greater than the revenue earned, the company ends up reporting a loss. The income statement is useful because it helps stakeholders evaluate whether a company's operations are efficient and sustainable. It also allows comparisons between different periods to see whether the company's performance is improving. The cash flow statement. While the income statement measures profit, it does not always show how much cash a company actually has available. A company can report profit but still face cash shortages if payments are delayed or expenses occur before revenue is collected. This is exactly why the cash flow statement becomes an important financial document. The cash flow statement tracks the movement of actual cash entering and leaving the business. It explains how cash is generated and how it is used during a specific period. The cash flow statement is usually divided into 3 sections. Operating activities. Operating activities include cash flows that arise from the company's primary business operations. Examples include cash received from customers, cash paid to suppliers, salaries paid to employees, taxes paid to government. Operating cash flow shows whether the company's main business activities are generating sufficient cash. Investing activities. Investing activities cover financial transactions involving the purchase or sale of assets intended for long-term use. Examples include buying equipment or machinery, purchasing property, selling investments, acquiring other businesses. These activities reflect how a company invests its money to support future growth. Financing activities. Financing activities involve cash transactions related to funding the business. Examples include borrowing money from banks, repaying loans, issuing shares to investors, paying dividends to shareholders. Financing cash flow shows how the company raises capital and returns value to investors. How these 3 statements work together. Although each financial statement provides different information, they are closely connected. The income statement indicates whether a company generated profit or loss during a particular time period. The balance sheet shows the company's financial position at a specific date. The cash flow statement explains the movement of cash into and out of a company over a period of time. For example, profits reported in the income statement may increase retained earnings on the balance sheet. At the same time, the cash flow statement may show how those profits translate into actual cash. By analyzing all 3 statements together, investors and managers gain a more complete understanding of a company's financial health. Why financial statements matter. Financial statements play an essential role in decision-making. Investors use them to evaluate whether a company is worth investing in. Managers use them to assess operational efficiency and plan future strategies. Lenders examine them to determine whether a company can repay loans. Even employees and regulators may review financial statements to understand the organization's stability and compliance. Because financial statements summarize large amounts of financial information in a structured way, they allow stakeholders to make informed judgments about a company's performance. Final thoughts. Understanding financial statements is a key step in learning how businesses operate. The balance sheet shows what a company owns and owes. The income statement shows whether the company is profitable, and the cash flow statement tracks the movement of cash. Together, these 3 statements form the foundation of financial analysis. By learning how to read and interpret them, individuals can better evaluate businesses, investments, and financial performance. This knowledge is valuable not only for finance professionals, but also for anyone interested in understanding how companies create and manage value.